Let me ask you something. Have you ever opened a trade and almost immediately thought, this wasn't actually part of my plan? Most traders have. We spend so much time learning when to enter that we barely practice the opposite skill, recognizing the moment when doing nothing is the better decision. Today, we're going to make that decision clear, practical, and repeatable. A moving chart creates pressure. A fast candle looks like opportunity, and the mouse is right there. Clicking buy or sell gives you an instant feeling of progress. But activity is not the same as edge. If the setup is unclear, more trades simply mean more spread, more slippage, more emotional noise, and more chances to break your own rules. The market does not reward effort. It rewards decisions made under the right conditions. Being flat is not being inactive. It means your capital is available, your risk is zero, and your attention is free. That is a real position with real advantages. The goal is not to avoid every loss. Losses are part of trading. The goal is to avoid risk that you cannot explain. A planned loss can be useful data. An impulsive loss usually teaches you nothing, because there was no clear idea to test in the first place. There is an important difference between discipline and fear. Discipline says, my conditions are not present, so I will wait. Fear says, my conditions are present, but I cannot accept the normal risk of the setup. Skipping everything is not good trading. Skipping for a defined reason is. Your no-trade decision should be connected to the chart, the timing, the reward, or your mental state. If you can name the reason, you can review it later. If you cannot, it may simply be hesitation. The first filter is context. Is the market trending, ranging, or shifting between the two? Your entry pattern does not exist in isolation. It depends on the environment around it. A breakout setup can work beautifully in expansion and fail repeatedly inside a noisy range. A mean reversion setup may make sense near the edge of a range and become dangerous during a strong directional move. If you cannot describe the current market type in one short sentence, wait. The second filter is location. A familiar candle pattern in the middle of nowhere is not the same setup as that pattern at a meaningful area. Ask where price is relative to recent support, resistance, the edge of a range, a prior breakout, or the structure used by your strategy. Good location helps define both the reason for entry and the place where the idea becomes wrong. If the only reason is that the candle looks strong, location is missing. The third filter is invalidation. Before you enter, you should know what price action proves the idea wrong. That is different from choosing a stop because the number feels affordable. A logical stop belongs beyond the structure that supports the trade. If that distance creates more risk than your plan allows, reduce the position size or skip the trade. Do not pull the stop into a random location just to make the trade fit. Risk should adapt to the idea, not rewrite it. The fourth filter is realistic reward. A clean entry can still be a poor trade when nearby structure blocks the target. The chart may offer movement, but not enough usable space. Measure reward to a level the market can reasonably reach, not to the number you want. Then compare it with the distance required for a logical stop. If the ratio only looks attractive after you ignore resistance or squeeze the stop, the trade is poorly shaped. Let it go. The fifth filter combines timing and your own state. A valid pattern can arrive minutes before major news, during thin liquidity, or around a session change when spreads and behavior shift. And even a good market can meet you on a bad day. After a loss, you may want the money back. After a missed move, you may want to chase. After several wins, confidence may become impatience. If urgency is choosing the entry time, step away until the decision feels ordinary again. Before the next entry, run a 5-question reset. 1. What market condition am I trading? 2. Why is this location meaningful? 3. What exactly invalidates the idea? 4. Is there realistic room to the target? And 5. Am I calm enough to follow the plan after the order is placed? You do not need perfect certainty. You need clear answers. If one answer is missing, waiting is not weakness. It is a request for better information. Imagine price jumps above a small intraday range. The breakout candle is large, and it feels as if the market is leaving without you. But the entry is already far from the broken level. The stop belongs below the range, and resistance is close overhead. That move may continue. It may even become the best move of the day. But at your decision point, the location is late and the reward is crowded. Skipping it is still correct if those are your rules. A winner you did not chase is not proof that discipline failed. Now imagine your first trade loses. 10 minutes later, price moves quickly in the opposite direction. You see a possible entry, but you are also thinking about recovering the loss before the session ends. The chart may contain a real setup, yet your state makes execution unreliable. Take a defined reset, stand up, record the loss, wait several minutes, and then rebuild the trade from zero. If the setup still makes sense without the need to recover money, you can evaluate it normally. If not, stay flat. The next candle does not grade your decision. This matters because hindsight is persuasive. When a skipped trade wins, your brain says you missed easy money. When a weak trade wins, your brain says the bad process was justified. Both conclusions are dangerous. A disciplined decision can be followed by a move you miss. An impulsive decision can be followed by profit. Review the information available at the time, not the outcome that appeared later. Process and outcome are connected over many trades, not guaranteed on one. Most journals record entries, exits, and profit. Add one more category: trades deliberately skipped. Save a screenshot and write one short reason: unclear context, poor location, invalidation too wide, reward too small, bad timing, or emotional pressure. Then leave the original decision unchanged. Do not rewrite it after seeing what price did. This creates evidence. You will learn which filters protect you, which filters are too strict, and which situations repeatedly trigger fear of missing out. Here is one rule to use in your next session. If you cannot explain the setup and its invalidation in one sentence, do not place the trade yet. For example, I am buying a pullback in an established uptrend, and the idea is wrong below the last higher low. That sentence does not guarantee profit. It forces the logic to become visible before money is at risk. If the sentence keeps changing while you say it, the trade probably needs more time. Your job is not to trade every day. Your job is to take planned risk when your conditions are present and protect capital when they are not. Check context, location, invalidation, realistic reward, timing, and your own state. Record the trades you skip. Judge decisions before outcomes. When you stop measuring progress by the number of orders, patience becomes easier, and the trades you do take become far more deliberate. If this was useful, subscribe to Atsushi K. Forex Lab for more practical videos on trading, psychology, backtesting, and automated strategies. Trading involves risk. No setup, filter, or automated system can guarantee